All right, so it is 7:37 in the morning on June 8th, 2020, and I think I found my next trade. So, if you're viewing this in the future, we are still in the middle of the coronavirus stuff. We've had protests going on for a week or 12 days, something like that, over the killings by police in Minneapolis of a guy on the street, and so yeah, all kinds of stuff's going on. And the market, as an overall, has not really cared. Sad to say. So, this big decline was the coronavirus panic, and then Feds turned the money printer on, and we've been rising ever since. So, and this is the S&P, and then here we have bring up the Qs. Let's see, Q. Qs are at an all-time high. And I'm waiting for a pullback on these to the 237 level to get in there. But the market breadth has been horrendous. So while the index of the S&P is almost all the way back to its highs, the individual stocks, I mean, there's like the tech companies, the FANGs, and plus Microsoft, whatever, that have been doing great. Amazon's been doing great. The rest of the companies in the S&P 500 have not been doing great from a stock price perspective. So that led me to start looking at some dividend payers and seeing if anything became attractive, because like 6% is pretty much my my target level, and there's some historical reasons for that, but basically perfectly happy with 6%. So I did a screener, I came up with some names, some really attractive ones, and Xerox caught my eye. So Xerox has fallen significantly from 38-ish down to the 16 to 20 range, and it's actually up in the pre-market right now, apparently, almost up to the top of that range. And yeah, so I was looking at Xerox, and I was like, Xerox is a great company. They have been around forever. They will have some headwinds with the change in office environments. So with everybody working from home with coronavirus, a certain percentage of the people are not going to go back to the office, and that's bad news for commercial real estate, especially the office sectors, and it's bad news for also office machinery. So, which Xerox would be one, but it's not going to be 60% drop in business, kind of bad for them. Xerox still makes great machines. I have two of them, and they will continue to be used as the standard for copiers, faxes, and scanners, and all that stuff. So, so yeah, this tickled my fancy, and like I said in my last video, it's always good to look at the big picture before you get involved in the small picture. So if we look at Xerox going back to 1969 here, we are pretty much at all-time lows. You could argue it's like, well, this one was 13 and that one was 16 or whatever, but in the range of all-time lows. And this was the dot-com bubble, which clearly was a bit overextended. But yeah, I mean, it's easily, historically between a $20 and $40 stock, even neglecting these bubble areas. So, so yeah, 16, the 16 to 20 range is a good place to pick it up. And, you have to think, will it survive? And I think the answer to that is yes. So that it makes the first cut on my screener list to be picked up. And so I go over to this is marketbeat.com, which is a great site for dividend kind of stuff, and they have this payout ratios, which is really great here. So next dividends at the end of July. Annual dividend's been $1. and I think this was from Friday's price. So the yield was 5.42, which is in the neighborhood of that 6%. Payout ratios are important. If you're looking for something like a long-term hold, you got to make sure that the company can afford to actually pay the dividend. So 28.17% payout ratio based on the trailing 12 months of earnings. 17.39% based on cash flow, because cash flow is not necessarily the same as earnings. 53.19% based on this year's estimates. Now that number is high. You don't want that to be too high, because that means you're consuming the earnings of the company too much, and then they might have to cut the dividend. So this year's estimates, though, that's a wacky number. We're heading into Q2 earnings season, and yeah, it's going to be bad. But it's a very open question what the remainder of the year is going to be like. So that's a little high, and might indicate that they'll cut the dividend a little bit. And then based on next year's estimate, which is just wild guessing anyway, is 34%. So okay, so based on this, I feel comfortable that the payouts are not too high. The company will be able to continue to support these payments. There might be a cut potentially based on this year, down from $1, but it won't be like half. It'll be, it'll go from $1 to 90 cents, something like that. And then just to look a little deeper, I went over to Yahoo Finance because I like their financials statement. And here we have the last 4 years plus trailing 12 months. So total revenue has actually been going down, which was surprising to me, actually. Cost of revenue, gross profit, operating expenses, R&D has been pretty steady, falling a little bit. SGA has been also falling, so that's good. Total operating expenses. So even though top line is down, OPEX is down too. And so, operating income or loss has been, it's been up and down, but fairly steady. Interest expense has been cut quite a bit, half from back in 2016. And interest expense we did. So total other income expense / expenses net is negative 148. And income before tax, it has been doing okay. So like 16, 17, 18 have been in the upper 500s, and trailing 12 months have been 744. So that's actually pretty good. We'd like to see that growth. Income tax expense, of course, income from continuing operations. So that number has been pretty strong compared to previous years. And then we have the net income number, which has been good. Again, strong growth compared to 2016, 17, 18. And for the 2019 numbers, we have basic and diluted earnings per share, and the EBITDA. So EBITDA I don't really care about. But so if they're paying on $1 and the diluted earnings per share is $5.80, then that's plenty of room to pay. And even in these leaner years, they still have, if you go back to the market beat, they can view the dividend history. You can still say they were paying. I mean, there was some small adjustments in 17. So 16 was a bad year, but then they adjusted to 25, and it's been steady ever since. So that's all right. And then if we go over to the balance sheet, because the income statement is just one of three. So everything's already expanded. Okay, so cash on hand has gone way up, which is, I think, a good move in the current environment. Receivables been pretty steady. Inventory's gone down, so that's a little bit of a concern. So they consumed, let's call this average 850, and now they're down to 700. So they've consumed 150. These are in thousands. So this is 150 million of inventory, and how much should they sell that for, and how much of this cash on hand is because of that? It's certainly not going to be all of it, but it's going to be a chunk. So, is that driving the cash flow? And the answer is going to be at least partially yes. I'd have to dig in to see what their their gross margins are. I mean, we can look back at the income statement here, and we can see that cost of revenue. Let's just call it there. So 5 against 8. So if they consumed 150 million, that'll generate 250 million of cash. So okay, so cash has gone up by way more than that. So that's not the whole story, but it is a piece of it. Other current assets has, I mean, compared to way back here, that's dropped significantly, and I'd have to dig in deeper to see what those current assets are. And then non-current assets, we got PP&E, which has been pretty steady. Accumulated depreciation, yeah, that's fine. So the net PP&E has been, again, fairly steady. Equity and other investments has dropped off a cliff, and that's probably where a good part of that cash comes from. So I'm actually okay with that. Goodwill is steady. Intangibles is, it's intangible. It's whatever. Other long-term assets, year over year, not too different. Way down from back in here, and that's probably related to some investment stuff. So then we have liabilities. Just top line liabilities has been shrinking, which is good. Currents is down. It's up compared to last prior 2 years, but then down from 16. And debt year over year has been more or less steady. Accounts payable is pretty steady. Taxes payable, accrued liabilities, that's all fine. Let's see, long-term debt, that's always a number you want to see. So that number is decreasing, which I like. And we've got other, deferred taxes liability, that's fine. So yeah, stockholder equity is growing. That's what I like to see. Yeah, and then we go over to the cash flow statement. So net cash flow, we got the prior 4 years and trailing 12 months. So we got the net income. We have depreciation add backs, which is smaller, but still a good number. Stock-based compensation, they've been paying about 50 a year. And accounts receivable, a little high. The accounts receivable has shrunk, right? Let's see, net receivables, yeah, has shrunk. So you got to add back the that number. Inventory, yeah, because they're consuming inventory compared to prior years. And the cash flows from investing activities, which is basically their PP&E stuff. Cash flows from financing was negative 1.3. Dividends, other financing. It's a little unusual in that, obviously these numbers are not quite fleshed out. And change in cash. So we're doing good. Cash at the beginning of the period, cash at the end of the period. So they've done a lot of moves in the last, from January to secure their cash position, which is what I want to see from a company that I'm looking to get dividends from. So overall, I'd give them, 7 out of 10, 8 out of 10 out of, their maneuvering. Pre-market's way up. So that might be a problem for my plans, but we'll see. So this makes the cut, basically. And what that means is, I want to buy. And the, so there's 2 ways. There's a lot of ways, right? So I could just go long and just ride the stock up, hopefully. I could buy calls and get a leveraged gain. I could sell puts. So selling puts is actually my favorite way to enter a stock position, cash secured puts. So like if I sell the, let's just call it the 18s. If I sell the 18s for June, it's now June 8th, and the expiration is the 19th, so I'd have 2 weeks. So if the stock stays above 18 for 2 weeks. Whatever I sold the put for, I keep that money, and then the call expires worthless, and we're good to go. And so I make whatever yield on the option that I have there. And if it falls below 18, that means I keep the premium, but then I have to pay $18 per share, times 100, per contract. So that'll be 1,800 bucks for a contract. Then I now own the stock at whatever price it is, and I paid 18 minus whatever premium I got. And the premium is going to be the big question with the market up like that in the pre-market. And then from there on out, I'm owning a stock with, a nice dividend. And so, what I would call a high quality name. So, yeah, I think that is what I'm going to be doing for my next trade. Now, once the market opens, I'll have to take a look at what the options are trading for. And really what I would want to do is I want to sell at 16s. That's like the bottom of this channel here. But if it's up to 20, what was it? 20 and 15. The price on the 16s might not be that great, but maybe I'll go out a month to July and pick up the options there, but we'll see. So yeah, that is the plan. And that's kind of how I go through a quick analysis of the first, screening stocks to find good dividend payers, selecting high quality names, looking at their price history and price and dividend history, and then comparing that to the financial statements to make sure that is sustainable. And then if so, then it goes into the tactical area of picking the right option to sell and entering the trade. So that's how you do it. And obviously, just looking at these numbers, these are gross categories. If you wanted to really dig in, you could go into their filings and get the full P&Ls and the full balance sheets with all the notes and footnotes and references and all that kind of stuff. But for my purposes, I'm happy enough with the company. It's a well-known thing that everybody already knows. It's a ubiquitous office equipment manufacturer. So I'm perfectly okay with that level of analysis. But you might go deeper if you wanted to pick up a good long-term play. And like I said, they are going to have problems with the change in office environments. But I guess I don't think it justifies going from 38 down to 16. So that's just my 2 cents, and we'll see how it works out.